Michael, you ready to go? Okay, let's do this. So I'd like to thank everyone for attending today. We're going to begin our webinar on investing in the zone. On behalf of Michael, myself, Richard, and Jerome, we'd like to thank everyone for attending the last webinar of our series this year. It's been a very interesting year to say the least. Kind of glad we're looking for 2020 to get behind us and get into 2021. In saying that, there is a strategy that we were reminded of this year at Signet Strategic Wealth called the Opportunity Zone. This was actually something that came about in 2017, but because of the lag time, government actually approving it, so on and so forth, and getting the product to market, it was a few years till it finally hit and came on board. This is an incredible strategy. It's involving real estate, and we are very lucky to be partnering up with Cantor Fitzgerald for this. Today, I have Michael Schotten on the call. He's going to be doing the presentation on the Opportunity Zone. As always, if you have any questions that are specific to your situation, please wait and you can ask us that independently. If you have general questions, as always, feel free to ask them on the chat feature of this, and we will answer them at the end of the presentation. Without further ado, I am going to present Michael right now. Michael, I'm going to make you the presenter. Take it away.
Beautiful. Thanks, Chris, and thanks everybody for joining us today. As Chris mentioned, my name is Mike Schotten. I'm based out of Santa Monica. I'm with Cantor Fitzgerald, Senior Vice President with Cantor Fitzgerald. I'll just go ahead and jump right in. There's a lot to get through today. Quickly, I'll let you know about our firm, Cantor Fitzgerald. We got started in 1945, actually in Beverly Hills. We're now based in New York City, but have over 12,500 employees across the country in 150 offices worldwide. We are a big player in the real estate business. We did over $84 billion in commercial real estate transactions last year. If any of you are in real estate, you may remember Grubb & Ellis. Grubb & Ellis was a company that was bought by Cantor Fitzgerald back in 2012. And so that's part of our Newmark Knight Frank brand that does everything from investment sales, leasing, and to about $1 billion of lending each month. For those of you who a lot of times you've heard of Cantor Fitzgerald, but you're not sure where. Unfortunately, most people know the name because of 9/11. Sadly, we had the top 4 floors of the first tower that was hit in 9/11, lost 658 employees that day. But we've rebuilt the firm to what you see today, and it's a real story in perseverance, and I'm proud to work for Cantor Fitzgerald. So let's jump into the Opportunity Zone program. As Chris mentioned, it came out as part of the Tax Cuts and Jobs Act at the very end, December of 2017. There was a lot of fanfare at the time in the investment world, but for you CPAs, it was actually buried under about 19 different pieces of brand new legislation that were part of the Tax Cuts and Jobs Act. And so over the last couple of years, it took the IRS and the Treasury Department until December of 2019, so a full 2 years later, before they finalized the regulation surrounding the Opportunity Zone. So while it may have been on some of our radars back in 2017, for a lot of people, it's fallen off. And I think now is a perfect time in December of 2020 to get it back on your radar, make sure you understand the ins and outs of it. And there's some real planning opportunities to be done with clients to really help them if they're facing a capital gain tax situation. So what is the Qualified Opportunity Zone program, right? It was created in the Tax Cuts and Jobs Act in 2017. And what it did was it created 8,700 opportunity zones across the United States. These are census tracts that plots of land anywhere from acres and acres of land in rural areas all the way down to a few city blocks in more urban areas that qualified based on the 2010 census. So these were areas that the government wanted to encourage investment in by providing some tax benefits for investors. So the actual zones themselves, the census tracts, are called Qualified Opportunity Zones. And you invest, as you can see under the how, you take advantage of those tax benefits by investing in qualified opportunity funds. And a qualified opportunity fund is simply just a fund that invests 90% of its assets in those qualified opportunity zones. So the idea was to deliver tax benefits to investors to incentivize them to invest in these areas that needed some revitalization. But again, they used the 2010 census data. So as I'll show you as we go along, there's quite a few of these areas that are extremely attractive places to invest in 2020. So as I mentioned, the QOZ, the zone, is the piece of real estate itself, and then the Qualified Opportunity Fund is the fund that invests in the real estate, and the fund is the actual vehicle that investors invest in. There are also Qualified Opportunity Zone businesses, so the government wanted to encourage people, if you wanted to start a startup or move your business into these zones to help redevelop, you can get the same tax benefits. But at Cantor Fitzgerald and in the fund that we're discussing today, we solely focus on investing in real estate in these zones. So here's a map, a very zoomed out map of the United States where you can see all of the zones. You start to see, right, very rural parts of Arizona, Alaska. The ones that you can see from this far zoomed out are not the zones that we are focusing on at Cantor Fitzgerald. This big one here in California, in Southern California, that's Death Valley. We don't expect for there to be a lot of investment going into Death Valley, but it's the tiny speckles here around the urban areas all across the country that we think are some really exciting places to invest and take advantage of the tax benefits that are part of the Opportunity Zone program, which I'll walk you through here in a moment. But it's pretty incredible. 18% of land across the country are part of Opportunity Zones now. With the 2020 census, wrapping up, there is the opportunity for the Treasury Department to add additional zones, but they cannot remove any of the zones that were originally put in place when the program started in 2017. We get the question a lot is, are we invested in blighted areas? So Newmark, again, Cantor Fitzgerald real estate arm, went through and looked at over the last 5 years, there's been $279 billion of investment that's gone into these areas. So again, 2020 looks very different than 2010 did. In 2010, when they created or when they used the data for these zones, we were coming out of the Great Recession, and there's been a lot of real estate investment in these zones. And so again, there's some really attractive areas to invest and take advantage of the Opportunity Zone legislation. The idea here is to create an impact, right? Is to revitalize these communities, increase the number of affordable housing units. Those of you in California, you know how important that is. Increase job availability, reduce unemployment, increase home ownership. The question comes up a lot because the Opportunity Zone program was put in place under a Republican administration. Will that change with a new administration? And the answer is it will not. The new administration has looked at making sure that we as sponsors are showing and transparent about the impact that we are making in these communities. And at Cantor Fitzgerald, we embrace that and look forward to whatever greater restrictions there are in terms of making sure that we are transparent about the impact that we are having. We are going to create more affordable housing units. We are going to create sustainable properties. And so we look forward to embracing that. All right, so let's jump into why we as investors or investors who may be our clients are interested in looking at Opportunity Zones, right? There's some great real estate investments to be made, but it's really about investing for tax purposes. Before I jump in, I just want to clear up a couple of things that I think are important to understand with a tax advantage strategy like the Opportunity Zones, right? Opportunity Zone, you can invest gains from any asset into an Opportunity Zone fund. So if you are a client or you have a client who is facing capital gains taxes, it doesn't matter if you sold a business, sold a piece of real estate, if you sold stock from a stock that's appreciated a lot this year, any capital gain can go in. But one of the differences, another tax strategy that you often see out there is the 1031 exchange. One of the biggest differences, besides the fact that the 1031 exchange is only for investment real estate, the Opportunity Zone, you have your basis and your gain. And in the Opportunity Zone, you only exchange the gain into the Opportunity Zone Fund. Unlike a 1031 exchange where you have to move your basis over with the gain in order to get the tax deferral. In the Opportunity Zone Fund, you decouple your basis from your gain. You pull out your basis completely with no tax consequence and can invest that however you'd like, and you're only moving the gain over into the Opportunity Zone Fund. So it's extremely flexible in that way. And as I mentioned, any gain is eligible, but at the same time, it's any taxpayer. So it doesn't matter if the asset that was sold is held in an individual, if it's held in a trust, if it's held in a corporation. They were very flexible in terms of who can invest in Opportunity Zone funds and then what gain was eligible to go into those funds. So let's jump into the tax benefits. And you see there's a trio of tax benefits here that you take advantage of when you invest in an Opportunity Zone fund. The first one is the tax deferral. So if somebody realized a capital gain in 2020, they are able to defer those taxes. So instead of realizing them in 2020, they realize those gains in 2026, specifically on December 31st of 2026. So instead of having your taxes due on your 2020 gain in April of 2021, you don't have those taxes due until April of 2027. So you get to defer for up to 6 years. And there's real value in that because you're able to invest your full amount of your gain, or whatever amount of your gain you want to invest in the Opportunity Zone Fund. You get to invest that full amount instead of having a huge chunk of taxes taken out and having the remainder left to invest going forward. And I'll show you on a dollar for dollar basis how impactful that is. But the first benefit is you're deferring your taxes so that they're realized December 31st of 2026. The second one is that when you finally do pay your taxes in April of 2027, you receive a 10% step up in basis. So if it was $1 million that was invested into the Opportunity Zone Fund, instead of having to pay taxes on $1 million in 2027, you're only paying taxes on $900,000. You get a 10% step up in basis and you're paying tax on the remainder. Now, I always like to draw a line here between the deferral and the reduction, and then the elimination, because these first two bubbles, the first two tax benefits, the deferral and the reduction, those are tax benefits on the gain of your original asset. So again, if it was a business that was sold, if it was a piece of property that was sold, if it was Tesla stock that was sold, you get to defer the taxes on that gain. And then when you finally pay them in 2027, you pay at a reduced amount. The third tax benefit, the elimination, that applies to the appreciation of the Opportunity Zone Fund itself. And so investors need to invest in the Opportunity Zone Fund for at least 10 years. And if they do, they pay no tax on the appreciation of their qualified opportunity fund. You may ask, hey, Mike, why is it 10 years? That was just what how the legislation was written. Essentially, again, we're trying to impact these communities. They thought if it was only 5 years, that's not enough time to see real revitalization in these areas. And so they set it as a 10-year investment. But what a tax benefit that is where your cost basis after 10 years steps all the way up to the value of your asset, completely eliminating the capital gains taxes on the appreciation of the fund itself. So deferral, reduce, eliminate. You defer and reduce on the original capital gain, and then you eliminate any capital gains taxes on the growth of the Opportunity Zone Fund as long as you hold for at least 10 years. So here's a quick hypothetical. This is in California. So if you're outside of California, this looks even better. As many of you may expect, California is a little bit more difficult when it comes to taxes, and they are one of 3 states that have a state income tax that do not conform to the Opportunity Zone legislation. So in California, if you're a California resident, you would still pay your California state taxes in 2021 for a gain that you sold sold in 2020, that would still be due, but the federal taxes would be deferred. You would pay a reduced amount on, and then you would fully eliminate those on the growth of the Opportunity Zone Fund. So this is for California specifically. It is still very lucrative, the tax benefits that you receive for investing in an Opportunity Zone Fund. So let's walk through this example, and I'll show you in this math here where the deferral, the reduction, and the elimination, where that value really comes into play. What we have here is $1 million gain on the left-hand column being vested, not being invested into an Opportunity Zone Fund, a qualified opportunity fund. And on the right-hand column, it is being invested into an Opportunity Zone Fund. Now, a couple of assumptions that are on this page: 34.1% tax rate. What we're doing here is you've got the 20% federal capital gains rate. You've got the 3.8% net investment income tax, or the Affordable Care Act tax. So that's a 23.8 federal capital gains rate. And then we're using 10.3% for the California cap gains rate. We know it goes up to 13.3, but the income has to be fairly high to hit that 13.3. So we find that more often than not, people are falling in that 10.3% range. The second assumption is just whether you go into an Opportunity Zone Fund or not, is that you have an 8% return for those 10 years that you'd be invested. So that's just our compounded hypothetical annual return, so we can compare apples to apples. All right, so if you have $1 million gain that you're investing in the Opportunity Zone Fund, remember, whatever your cost basis was, if it was a $500,000 cost basis, you sold it for $1.5 million, you pull out that $500,000 of cost basis, you have that free and clear to invest how you'd like, and then only the $1 million of gain is going into the Opportunity Zone Fund in this case. On the left-hand column, you're not going into the OZ fund, so you're paying 34.1% in April of 2021. That's $341,000 off of that $1 million that you're paying in taxes, leaving you with $660,000 to invest going forward. So here's the real value of the deferral. If you go into an Opportunity Zone Fund, you still pay your $103,000, that's your 10.3% in your California capital gains, but you fully defer the 23.8 of federal capital gains. So that leaves you with $900,000 to invest moving forward versus the 660. That's the real value in the deferral, having that larger amount to invest and grow and appreciate moving forward. So now we have deferred our federal taxes. We do have to pay those eventually. So we will pay those here in 2027. And when we do pay those, here they are in 2027 on the original capital gain. When we do pay them, instead of paying 23.8% on $1 million, right, which would have been if we didn't receive a step up in basis, we get that 10% step up in basis. So we're paying the federal capital gains rate on $900,000 instead of $1 million because our basis stepped up. So you look at the $214,000 plus the 103, right? You're at about 217 versus, I'm sorry, 317 versus 341 that you had to pay immediately if you didn't go into the Opportunity Zone Fund. So here's the reduction in the tax benefit in it. It's not the largest tax benefit. Oftentimes people focus on the reduction. The real meat of the tax benefits are in the deferral and having a larger amount to invest going forward, and then the elimination on the growth, which we'll get to here in a second. So you've got your 897 in your Opportunity Zone Fund versus the 659 outside of the Opportunity Zone Fund. If both of those were to grow at 8% a year for the next 10 years, the 659 would more than double. This is just the appreciation. So it would more than double by 763,000, leaving you with about 1.4 million there after the 10 years. Versus in the Opportunity Zone Fund, this 900,000 has grown by over $1 million. And so now you're at $1.9 million in the Opportunity Zone Fund. Now, when we sell at the end of 10 years, if you're not inside an Opportunity Zone Fund, you're not protected. You don't have any tax benefits. So on your appreciation that you see here, the 763, you've got to pay 34.1% in taxes. And so that's an additional $260,000 in taxes that you have to pay. Versus in the Opportunity Zone Fund, you completely eliminate the capital gains tax at the federal level. So the normal 23.8 that makes up this 34.1, you eliminate that completely. The only tax that you're left with paying is the 10.3% on your $1 million plus of gain, which is $107,000. So in this example, if you don't go into the OZ fund, your $1 million gain after 10 years of earning 8%, because of the 341 of taxes you paid immediately, and then the 260,000 of taxes that you paid at the end of the 10 years, you're left with only 1.16 million. Versus in the OZ fund, where you defer the federal capital gains taxes, leaving you with a greater amount to invest, and then you pay a reduced amount when you finally do pay in April of 2027, and your growth on the larger amount that you invested in, you don't pay any taxes at the federal level on that. You're left with $1.6 million at the end of the 10-year period. So when you look at that, in this example, that's a $452,000 difference between not going into the Opportunity Zone Fund and going into the Opportunity Zone Fund. And that's in California, where it's, where they don't conform. That tax benefit gets even larger if you go into other states, or if you're a resident of other states or have clients in other states. If you look at a 9% compound return here in the footnotes, that number grows to 562,000. So the better the fund performs, because you're eliminating the federal capital gains taxes on that fund, the greater the tax benefits are. So in this case, 452,000, that's a 45% savings over a 10-year period off of your $1 million. All right, so I'm going to jump ahead a little bit and get into a little bit more of how this works in practice. So if you're looking at what gains can be invested in the Opportunity Zone Fund, Form 8949 is the worksheet that you use to fill out Schedule D. And so 8949 shows your gross gains and losses. It's the worksheet where you fill it all out. If this hadn't been cut off, you just have line after line where you can fill in that information. So one of the key things is it's not the net gains that you can invest in an Opportunity Zone Fund. It is the gross gains. And so we show Form 8949 here because you can total up the gross gains and see that's the maximum amount in a year that you can invest into the Opportunity Zone Fund. It doesn't have to be the exact same monies that you sold out of your asset that go into the Opportunity Zone Fund. If you have cash in an investment here and you end up spending or using the funds, the proceeds from your sale for something else, you can still invest that other cash that you have as long as you can show that you have gains on your Form 8949. And you don't have to invest your full amount of gains. You can take a portion of that. You know that you're paying taxes normally on whatever you don't invest, whatever gains you don't invest in the OZ fund, but you can choose to just invest a portion of your gains into the Opportunity Zone Fund, and you know that you're going to defer, reduce, and eliminate the taxes at the federal level on whatever you do invest. And then again, for the CPAs on the call, Form 8997 is a form that you may not have seen before because it's brand new for Opportunity Zone. So if you don't have a client that's used Opportunity Zone funds in the past, you wouldn't have seen this. It's so straightforward. It's very straightforward. All they're asking for is the tax ID number of the fund, the OZ funds that they invested in, the date that they invested, the name of the Opportunity Zone Fund, and then how much of short-term or long-term gains were invested. You can invest short-term gains into an Opportunity Zone Fund. The tax benefits are going to work the same. The only difference is when you pay your taxes in 2027, if you had invested short-term capital gains at the beginning, you're going to pay short-term capital gains rates in 2027. So you deferred, but you haven't switched them to short-term to long-term. They're going to stay short-term gains, but you still get the benefit of investing a larger amount that can grow over that 10-year period. So both short and long-term gains can go in, and this is where they keep track of that. And so you would fill out 8997 for every year that the investor is invested in an Opportunity Zone Fund, and then you would fill it out again in the year after they sell out the Opportunity Zone Fund so that the IRS can see that that was closed out. Again, I mentioned at the beginning, it took quite a while for the Treasury Department to finalize the regulations. They came out with, it was only 8 pages of legislation in December of 2017 when it first came out. So there was a lot more meat to put on the bones of the legislation. And that was finally completed in December 19th of 2019. So if this feels newer to you, it's because it is fairly new. We didn't have all of the final regulations in place until the end of last year. Now, something that's extremely important, because of COVID, there has been an extension for any investors who have a capital gain over the last year. So let's look at this. So on June 4th, the IRS put out IRS Notice 2020-39. And what that said is if a client, normally you have 180 days from when you recognize your gain to get into the Opportunity Zone Fund. So normally your 180-day period just ends 180 days after you sell your asset or you realize that gain. But for anybody whose gain would have ended, their 180 days would have ended after April 1st, but before December 31st, their deadline was extended to December 31st of this year. So that's really important. So if you count back 180 days from April 1st, you get October 4th of 2019. So what that means is any investors who realized a capital gain going back to October 4th of 2019 still has another month, still has another 30 days, 29 days to invest in the Opportunity Zone Fund and get the deferral, the reduction, and the elimination tax benefits. Even if they filed their taxes, you can file an amendment, costs a little bit, but it's worth it if you look at what those tax savings are. So there, I suggest going back through and seeing, hey, who did I have a conversation with who paid these gains? And there was a difficult conversation to have about having to pay all these gains. Well, we may be able to get that back for them because of this extension going back now to they have until December 31st. Again, October 4th, 2019 is the key date. If somebody had 180, if somebody had recognized their gain in the second half of this year, so let's say they sold in August, they still have 180 days, and that'll go into 2021. So that hasn't sped up their deadline to December 31st. They can still go in to next year. Now, a couple of exceptions to the 180-day rule, in addition to the extension of the deadline. So if somebody has a gain in a K1 partnership, so they receive their gains through a K1, what happens is because K1s take so long to be sorted out and come out, what the IRS clarified in those last regulations is that you have 180 days starting on the date that the partnership's tax return is due. So let's think about that. If somebody sold an asset in a K1 and they sold it in June of 2019, they would normally have 180 days after that tax return was due. That tax return for that June of 2019 sale would have been March 15th of this year. You move forward 180 days. Now you're sometime after April 1st. And because of the deadline, that investor who sold in 2019 has all the way until the end of 2020. They have another month to invest in the Opportunity Zone Fund. They could have sold inside of that K1 going all the way back to January 1st of 2019 and still have until December 31st to get that investment into the Opportunity Zone Fund. Same thing if they have Section 1231 gains. So that's real property used in a trade or business. So in this case, an investment property, but one that was held in their individual names, not put into a partnership or an LLC of that kind. It's the same thing because it took them a while to finalize the regulations and they didn't give clarity until December 19th of last year. For 2019 specifically, any investors who have a Section 1231 gain, an investment property, they can go all the way back to December or January 1st of 2019, and they have until December 31st of this year. So if you're a realtor and you have clients that you know was trying to execute a 1031 exchange last year, or they sold an asset and they paid capital gains, they still have another month that they can go in to an Opportunity Zone Fund. So it's worth having that conversation to see if this might be the right fit for them. Again, comparing opportunity zone funds and 1031 exchanges. I work with a lot of realtors out there, and they're looking for ways that they can help their clients. And I think that the opportunity zone, because you don't have to identify within the first 45 days. There's no qualified intermediary that has to hold on to the money in the meantime. The opportunity zone can be a much more flexible solution for investors who are selling investment real estate. But something else, somebody selling a primary residence. I know a lot of clients who are trying to downsize. The kids are off at college. They don't need 4 or 5 bedrooms anymore. They want to downsize moving forward. Well, they sell their primary residence, they downsize, they've got a $500,000 exclusion that you get here in California, but their gains are much higher than that. Well, they can put a portion of that into the Opportunity Zone Fund, or all of that into the Opportunity Zone Fund, and get the tax benefits that they would have received, because you can't 1031 exchange a primary residence, but you can go into an Opportunity Zone Fund from a primary residence. One last piece that I want to touch on, because I see a lot of this, is for people trying to execute 1031 exchanges this year. If for some reason it fell apart, they weren't able to find a replacement property, they weren't able to get financing, they were outbid on one of the 3 properties that they had identified, typically what happens is that qualified intermediary holds on to those funds until day 180. And so that doesn't help us normally in an Opportunity Zone Fund, because you only have 180 days to get into that Opportunity Zone Fund. So unfortunately, that QI or the accommodator is going to hold on to those funds and not give us time to get into an Opportunity Zone Fund. But because this year we have that extension where you can go past the 180 days to December 31st, if somebody did have a 1031 exchange that fell through, they still have another month to be able to get those funds into an Opportunity Zone Fund and take advantage of the tax benefits that you see there. So I know that was a lot of different things that we touched on, but I wanted to make sure you fully understood the tax benefits, the deferral, the reduction, and the elimination. And then I wanted to give you some ideas of different areas that you can really put to use these tax benefits. So what to do from here? Make sure you understand the program, and Chris can help you walk you through some of the details. I know we're going to have questions here in a second, but go back and look at the realized short-term or long-term gains going back to October 4th. Look at any unrealized gains or concentrated stock positions that you may have been wondering, how am I going to address these? The Opportunity Zone Fund is a solution that you have. And again, with real estate from January 1st of last year, or K1s from January 1st of last year, you have another month to invest going forward. So I'm going to stop there and turn it back to Chris and see if there's any questions.
Sure. So I see some questions coming up, but first of all, Michael, thank you as always for taking the time to work with us, present the information. To all my clients on the webinar today, I would say this was a ton of information. A lot of it is just like water on the rock. It hits you really quickly. The intent today isn't to jump into the strategy. It's educational. It's to understand it's out there. This is something that's coming out now. I know a lot of people are going to have a lot of questions about this. What I would say is this is a great introduction to, yes, a very complex strategy, but it's actually a very simple solution when you look at it. So it's something that we'll have up on the website. Feel free to go back through it. If you think it's appropriate, reach out to me and I can set up a call with Michael and myself and you, and we can go over your exact situation. Because this has a lot of moving parts, I think that a lot of what people might want to know will have more specific questions to themselves, Michael. But for general questions, so for example, someone asked, what is the minimum investment in something like this? And then there was another question in that about opportunity fund tickers would we recommend? This is, just so we're clear, this investment is a private placement and it's a real estate investment trust. So this doesn't trade to the person who asked the question as a regular stock symbol trades where there's instant liquidity on the NASDAQ or whatever. This is a private placement. And that's something I'll go over with you independently about how they actually work in your portfolio, because they work differently and don't necessarily have tickers the way you would think they do. We also have another question coming in about the deck. And will there be review for it? And so, yes, again, we're going to have this up on our website. People will be able to review it as much as they would like. And if you want to learn more about it, simply shoot me an email and let me know. I can set up a time to talk with Michael, and we can obviously discuss what your needs are. If it's time sensitive, please let me know sooner rather than later, as there are elements to this that have benefits if you do them prior to the year ending. Just want to see if we have any more other questions that have come up. We've got a couple more questions here. Just give me a moment. Can you place, okay, so one is, can you place a portion of the gain in the zone and realize the tax benefit on portions of the gain?
And yes, you do not need to invest your full gain into the fund. Whatever amount that you invest, you get those tax benefits. And again, whatever you don't invest, you would pay the taxes as normal. So you can do a portion and receive portional tax benefits.
Okay, wonderful. There's another question that came in. No, to answer your question, this was not a call that included banking and savings with the strategy. This is one more. Okay, I believe that is it, Michael, for now. So again, I'd like to thank you and Cantor for taking the time to present today. I'd like to thank everyone on this webinar. I know it's the end of the year. You got a ton of stuff going on and it's a crazy year, but this is really important to learn about. It's one of the true last deferral things out there. I think with all the stimulus, with everything going on, this may be really important for some people on today. So thank you for taking the time. And if you want to learn any more about it, as always, shoot me an email. Other than that, have a wonderful year end and a very safe holiday season, and stay healthy. Thank you all.
Thanks, everyone.
Thanks.